All right. Hey, I'm Matt Hudgins. He's Dave Mulvaney, and this is Profitability MD. Dave, how you doing today, buddy?
Matt, I'm doing fantastic. Tomorrow's Thanksgiving, one of my favorite holidays, the longest weekend of the year normally for most of us because Thursday's a fixed holiday. How about you? How you doing today?
Man, life's pretty good. A little drizzly. Actually, it's raining, pouring down right now because I was hoping to kind of get out during the weekend because of the long weekend. You can get out and play a little golf and stuff like that. So we'll have to see.
Well, you can see I'm in short sleeves and you're wearing a jacket. So
I know, a little chilly. It's exactly
today it's going to be 80 today here and sunny in Florida. I will play golf on Friday, so looking forward to that. What would you like to cover today, Matt?
Let's see. I was thinking episode 49. Let's talk about good debt versus bad debt. Kind of money mistakes people make, good debt versus bad debt.
It's a great subject. I did a blog post on it. And I want to mention Dave Ramsey and Grant Cardone because they're in an argument head to head right now. It's actually it's probably great for both of their companies because they're going head to head. Like Dave Ramsey will make comments about Grant. Grant will make comments about Dave.
Oh, they actually go head to head.
They're not talking to each other, but they are talking.
Oh, okay. Well, what is it? Ramsey is no debt. Like Dave Ramsey is zero debt.
Dave Ramsey is zero debt. Pay cash for your house.
Okay.
And then purchase cash flowing assets. So it's not far from what we talk about.
Okay.
But I tend to think there's a mix, and that's what we're going to talk about. And
right.
Grant is don't own your house, purchase cash flowing assets, use all the leverage you can get your hands on. And leverage is what makes real estate the most appealing investment probably on the planet. Because if you want to go buy 1,000 shares of Apple, what are they, like $2,000 a share?
Right.
Cost you $200,000. But you can potentially control a piece of real estate that might be worth $1 million. So instead of controlling $200,000 worth of a share of stock, you could control a piece of real estate worth $1 million and with the same $200,000. And in many cases, if you bring in syndicate or you bring in other investors, you may not have anything invested and still be a portion, control a portion of that $1 million piece of real estate. Right. So let's talk about good debt versus bad debt. You had a client, so let's.
Yeah, I got a couple examples. It's kind of the difference between what, rich dad, poor dad. And so here's what the rich guys do, rich dad, poor dad, right? And here's what the bad decisions are, right? So there's good debt and bad debt. And so, we're starting off with you have money, you got an inheritance, you got some money, right? And so typically what happens, and I've seen this from inheritance, I've seen this when somebody wins a lawsuit, sudden wealth. They call it the sudden wealth syndrome. Okay, literally it has a name called sudden wealth syndrome. And people get this money and they don't know what to do with it, and so they spend it, right? Instead of letting the money work for them. Like you've heard that term, money work for them. But so here's a real good concrete example, all right? So you inherit some money, you win a lawsuit, whatever your dollar amounts come from, right? Now, a lot of times what people do is they go buy a fancy house. So let's just say you got $1 million, we're gonna go buy a fancy house, $500,000, $600,000 house. Now what do I got? Now I've only got $400,000. I say only, right? But then they start to think about, wow, that's not a lot of money. I should buy some, let's call it, we're using real estate in this example, some income producing properties. I should pay cash for that. So I can go ahead and pay cash for my rental property. And then I won't have any debt, the Dave Ramsey, won't have any debt. I got my house free and clear. I'm buying my rental properties and I'll get, off that $400,000, I'll get a 10% return, $40,000 a year. Right. And that's if they're lucky. That's if they quasi did it right. But here's a mistake I was trying to get at was, how do I say this? All right. So here's the exact example. I can give you exact example, no names and stuff like that. But it's literally what you could have done is just go, you got your lump sum, right? You got your $1 million. Why don't we just rent a house? We're going to rent a house. We're going to rent a nice beach house. We're going to rent whatever, a nice little house, swim and tennis neighborhood, whatever you want. You're going to rent that house. Now you still got your asset base, right? You still got your cash, right? Cash is king. From that, now we can buy some income producing properties, rental properties, right?
It doesn't have to be, like you said, the stock market this year is 25%, up 25%. Right. So you could, that even does produce income in the stock market. So we don't
And that's what I'm biased. That's what I would tell you to do is you should have that in the stocks and bond diversified. So it's going to grow. So it's not just sitting there in cash. It's going to grow. And this year, like you said, the stock market's up 25%. Bonds are up, whatever, almost double digits anyway. So yeah, you're going to have that cash sitting in some other sort of investment. You can, banks will let you borrow against that money to buy the rental property, right? So you're going to go buy a $50,000, $100,000 house. You don't have to take the $100,000 out of your lump sum. You could say, hey, Mr. Bank, let me borrow $100,000 and I'll use my $1 million as the collateral.
So can I ask you a quick question? And this is, so could you, let's just say, take $500,000 and invest in, we'll say liquid securities, or I mean, not liquid securities, but stocks, bonds, those type of things, and still borrow against it?
Absolutely.
So
that's actually what I recommend.
Double leverage, right?
Yeah,
so
double leverage, right? So you're investing the money in a diversified portfolio, so it has the potential to grow, right? And you can still borrow against it. Two different ways. There are different ways you can borrow against it. You could borrow against it with a bank loan, with a secured. You could do what they call a margin loan. So there are different types that you can. But yes, you're investing it over here in the stocks and bonds, and you're leveraging it because you're borrowing that money to go. Now you buy your rental property, right? So your rental property will produce the income that pays back the loan, right? But it could also be paying for your rental house that you're living in, right? So here's a scenario where I'm almost going through this right now, where somebody had $1 million and they're down to 400,000, right? And they're now doing the rental property thing. Instead, they could have had the $1 million. Markets are up 25%. It could be worth 1.25 million, and they could be renting a house because they were renting a house before, right? And so you could have actually more money, and then you could buy more rental property than you could have a year ago because you wasted your cash. And really, this goes back into what we talk about business owners do all the time, in that your cash is more important than the bank's cash. So don't waste it, right? Like we talk about for business owners, they buy a piece of equipment or they hire an employee, right, without doing a return on equity. Whereas you had to borrow money to buy that piece of equipment from the bank, you would say, well, gosh, can I generate enough income from that piece of equipment to pay the loan back, right? What these people are doing is they're not doing that. Oh, I'm going to buy my house and I don't have to worry about paying myself back. Right?
Yes. So let's pause there because we are talking good debt versus bad debt. Right. So let's kind of define the good debt, bad debt. The definition, I think, of good debt would be any debt that produces more income than it costs you to service the debt or pay the payment on the debt.
Right.
That'd be considered good debt, right?
Yeah, exactly. And I even think that's what the rich dad, Robert Kiyosaki, talks about, right? So bad debt is to use it to buy a depreciated asset. Borrowing money to buy a car, we know the car's value goes down. That's bad debt, right? Borrowing money for rental property or for real estate or other investments that grow would be good debt. Matter of fact, there's a funny thing talking about the car. Would say, okay, let's say you're going to buy a $50,000 car. You can go pay cash for the car, or you can go buy $50,000 to buy a $100,000, $200,000 piece of real estate. Use the rental income to go buy a car for you and make the monthly car payments.
And maybe cash flow on top of it.
And maybe cash flow on top of that. So there's I don't even know if that was a Kiyosaki thing or a Robert Cardone thing or something, but I know I've seen that strategy before where you.
So the bad debt side of it then would be, and this is where I really think that there's stages of life. Well, you start out and you're just in the survival mode, just trying to it's right. When people move from survival mode into what I call a sustenance mode, they now have their bills covered. Most people stay in that stage their entire life. They never move to abundance because every 3 years they finance a new car. They upgrade their house every 5 to 7 years. And they live in this life where technically you become a slave to a bank, where you're always working for the bank.
Right. And consumerism. I call it consumerism. You're a buyer. You're a spender.
And so let's back up and talk about that $600,000 house that you pay cash for. Okay, so you're assuming you now own this house, and you technically own the house, but if you don't make the taxes on it,
Right. You still owe taxes, insurance, property, repair and maintenance. They say it's about 5% a year of the cost of a house, right? So there's 15.
Depending on where you live. If you live in Ponte Vedra Beach, you're going to be paying like a very high tax rate. So you buy that $500,000 house in Ponte Vedra Beach, it's going to cost you $15,000 a year.
Well, not only that, you got repairs and maintenance from the salt water and the breeze. So your repair and maintenance costs for that house go up. So it's not, and now there is an argument that it's an appreciation asset, right? That real estate goes up X% a year, but there's actually all kinds of research that says, yeah, but if you back out everything we just talked about, your taxes and your insurance and your repair and maintenance costs, it might just be a break-even scenario at best. Right?
Okay, so let's pause for a minute. So this is the argument between Dave Ramsey and Grant Cardone. It's also an argument through a lot of people, because this is a real discussion about how do I buy my house, right, or do I? There's a philosophy in real estate is everybody's got to live somewhere. Right. So Larry Goins is a big real estate investor, and that's his statement. Everybody's got to live somewhere, so don't be afraid to buy in areas that you wouldn't live yourself. I don't necessarily agree, but at the same time, everybody's got to live somewhere. If you take this sudden wealth syndrome and you go invest it, you can rent somewhere, probably at a much nicer place than you could actually afford. So,
and it's a known cost, by the way, because it's just that. Don't have to worry about property tax or repairs or the hot water heater blowing out.
You don't have to really, if you structure your lease right, you don't have to worry about anything. I know places where the landlord, if a hurricane comes, if you're in the South, a hurricane comes, the landlord comes and puts shutters on the house. You're not even working to protect the asset. And believe me, if you live in the South and you have to deal with hurricanes, that's a big deal to not have to go out 2 days before trying to buy plywood, trying to do all this stuff.
So you had a funny story that's related, was that I actually have one of my good friends, and they sold their house. Somebody came in and made an unbelievable offer, to buy the house. And oh, great. And so they were going to go rent a house for a year because they weren't really expecting this and where to go live. It's been a year and a half now. They've been in this rental house, and he loves it. He doesn't have to mow the lawn. He doesn't have to take care of the pool. The rental house, takes care of all that for him. And his wife is the one, we got to go buy another house. He's like, why would I leave here? I do nothing, and I just pay a flat fee, and I know exactly what it is. So he's loving it, the rental life. And he just has that asset, the cash he took from his house, because he did own his house, and he just has that sitting in investments, and it's growing and making money. So he's like, I'm making money, and I don't have to do repair and maintenance or anything in my rental house. It's hilarious. He's loving it. So it just came to my mind as you're talking about that.
Well, it's funny. I'm having this discussion with my son, who is 25 years old, and he's got himself out of debt. He financed a car and had some credit cards, but he's like, what should I buy in terms of a house? I said, and he's like, I think I should buy a duplex or a triplex. I'm like, that is perfect.
Right.
Because he can live in one and live for free. My first investment in real estate was I bought a duplex. It was completely trash, full of rats, but we fixed up one side. We moved into that side, and then I fixed up the other side, and I lived for free. And literally, I went on to buy my next house that I lived for free. So this is where my asset was paying for my mortgage. So the duplex paid for my second house, the payment on the second house, and we had cash flow. So that's where I kind of lean toward, well, it's okay to own something if someone else, other people, tenants, are making your payment for you. Why not?
Right.
Rental side of it is, I get it. Like, I am going to use Grant Cardone. Grant Cardone says, look, he's got 5 houses, is what he said. I have 5 places. My payment on them is like $20,000 a month. Think about that. 5 times 20, all right? Those are his rent payments. He goes, but I live in the most unbelievable places, but my income, I've got so much income, but I don't have to maintain these houses with a $20,000 a month payment. You can bet he's living in a $10, $15, $20 million house.
Right.
When you're living in a $10 or $15 or $20 million house, or I know he has a New York condo, he's got a Miami condo, he's got a Miami house, and he's got a California. But that being said, he's living in something way nicer than he could ever make a payment on for 20 grand a month, and he's not having to maintain it. That's the point behind good debt. Bad debt is you can live in a way nicer place than you could probably afford, and you've now taken your money and it's making
right, right. And we'll go. I'll go on two sides of this. One, so Millionaire Next Door is a book. It's a famous book, and there have been a couple of them that iterate millionaires, and they talk about, you know, the real millionaires don't buy the $1 million houses. They live in one house. They call it one house, one wife, and like one car.
And you know what that car is? The majority of millionaires drive. Do you remember that from the book?
I don't remember.
The number one vehicle driven by millionaires is the F-150.
The F-150 pickup. I knew it was a pickup truck.
Yeah, it was F-150.
Yeah.
I was like, really? That's cool. So
yeah, and those guys typically they buy a car and they own it for 10 years, right? 10 years or plus, right? So they're not buying the car every 3 years like you were mentioning. So they don't get on the consumerism thing. They buy one house and they pay it off over 30 years. So that, you know, for them, that's fine because they never do the upgrade. Warren Buffett still lives in his house and whatever. So it's a little ranch, apparently.
Omaha, Nebraska, I believe.
Omaha, Nebraska, a little ranch or something like that. So there's all these, like the real millionaires aren't driving the Ferraris. The real millionaires aren't living in the $5 million mansions. They're the millionaire next door. Is the point is these guys are the ones that are living within their means and making the right good money choices, right? Instead of money mistakes, right? The second part, what I feel like obligated that we should mention is also there's a downside to the leverage stuff, right? So you buy all these rental properties and then all of a sudden you don't have a tenant. Holy smokes, how do I make the payments, right? So we should equally talk about when you run your calculations that you should take into consideration what happens if I don't have a tenant for 3 months, 6 months, a year, right? That you don't want to be so leveraged that you know, one empty tenant will send you over the edge, right? That you need a balance of some sort of reserves or access to reserves that you can get to it. And that could be a home equity line of credit off your existing house, right? So we got all my other money is invested, but then I could get home equity out of my house to make up for something, right? But you need to be aware of that I think I've also seen the money mistakes that people get over leveraged. And it's like, oh, they're assuming 100% rental rates. And no, that's not how it works. Even with, you know, you've done this a lot more than I have, but even there's always somebody moves out and it takes 6 weeks, 8 weeks for somebody to move in, or somebody moves out. It
might take longer. I mean, I have a rent to own program and sometimes I'm on a house 4 months before we
there you go.
Person. So you're making that payment for 4 months that, you know, you gotta prepare for that.
Gotta prepare. So be leverage to the hilt and all that kind of stuff. Am I getting jumping again?
A little bit.
All right, we're back on. Now we are back on track. Yeah. So leverage is great. Too much leverage is a bad thing, right? Too much leverage is a bad thing in anything, right? So you talked about the stock market earlier, and you can buy that Apple stock, but you know, you could actually buy options. And so you could control that $200,000 for something like $10,000. So you can use options, which is highly leveraged, but 95% of the time, those things expire worthless. People lose money in options, but you can use leverage in stocks. You can use leverage in real estate. And it works great when things are going up, but when things are going down is when they hurt you.
Yeah, we could even get into covered calls and covered puts.
Yeah, I'm just saying that there is, you got to be aware of the downside. Like part of the way that I evaluate things is what's my worst case scenario. So we do this scenario and we buy, you know, a rental property or several pieces of rental property. If I can't rent it out, how long can I carry it before things, you know, affect me? Right. And because I think the upside will take care of itself. I'm not going to assume 100% rental rates and, you know, it's all fine and dandy. Right. Because the truth of it is, like you said, it could be 4 months, it could be 6 months, maybe the hot water heater blew or needed a new air conditioner. I got to have money for that. So I always run things on, here's kind of like the most likely outcome, but what is the worst case scenario and can I afford it under the worst case scenario? Most people run it on the best scenario.
Yeah, I think you ought to think, especially in real estate, depending on your market, of course, but 85%, you should never do your calculations above 85% occupancy. I don't.
That's a great number.
I see some people doing 93% projections, and I'm like, you know, if you want to make the numbers look really good, that's the only reason you're doing it is because you're trying to get more leverage, because you can borrow more money. And if you really need that extra, you know, 7-8%, you're probably going to get into trouble at some point or another. It just is. So that's why I use the 85 number. I've even heard some people say 80%. If you calculate 80%, you'll never get hurt.
And that's kind of almost like my worst case scenario, right?
Yeah.
Maybe that's a different way of doing that. But we got to be aware of that so there's good debt and there's bad debt, and we don't want you to leverage to the hilts, but we don't want you to pay cash for everything either, right? So understand that there are people that are the Dave Ramsey, hey, no debt, no debt, no debt. And if that's what you need to sleep at night, perhaps that's okay. But it may not be the most efficient way of doing things, right?
As long as here's the thing. Here's where companies get in trouble and I say companies, business owners get in trouble. They get into a situation where their business is doing really good and they get advice from their accountant. You're going to be paying a lot of taxes.
Yep. So let's buy something.
They go finance some trucks or they finance some vehicles. They might finance some equipment, none of which is going to make them any money. It's just
right. There's no return on investment, right?
I'm just using the tax code to my advantage. I don't want to say avoiding taxes.
Right.
You're just using the tax code to your advantage. And then they buy all this stuff, financed, and then 2 years later, the business isn't doing nearly as good as it was 2 years ago. And now they're in a situation where they've got all these payments. That, again, is bad debt. And this is, I believe, the number one killer of companies is this type of debt. Sears 2018, Sears went through bankruptcy.
Right.
What a lot of people don't know, or I don't know if we've ever talked about this on the show, but they had $22 billion in revenue in 2018. They had $4.690 billion in gross profit in 2018. They went broke with $4.690 billion of money that they could spend. So their basically their liabilities and their expenditures exceeded that $4.6 billion. So even big companies make this mistake of taking on these bad debts.
Right.
During times when they're trying to use the tax code to their advantage, but that can be a downward spiral. When you're looking at debt, I believe you should say, is this going to make me money or is it going to cost me money? That should be the question you ask when it comes to debt. And if it's going to cost you money, you have to back up when you were talking about.
Choice. Yeah, that's a choice.
Yeah, that's your choice. Is this going to cost me money or make me money? So I'll give it for instance. You said millionaires don't necessarily always drive nice cars. Let's say you want to drive a Ferrari and that's your thing. And let's say you've got tons of income, $100,000 a month. Let's say you got $100,000 a month. Well, you can lease a Ferrari for 12 months.
Right.
If you've got the income, then you don't have to own that asset. You don't have to, and it's like renting it for 12 months, but then you get the advantage of driving it. You get all the whatever you're going to get out of that. And then you have the option to say, I don't want this anymore at the end of 12 months. And you don't have to worry about selling it. You don't have to worry about any of that.
There's actually, I should get a promo for this. There's actually a company here in Atlanta and they're in other cities. They're expanding. And I think it's called Turo or something like that. And that is exactly, you make lease payments, monthly lease payments, and you can drive any one of their cars in their fleets for as many or as few as days as you want. So it's like you're going you want to drive around town in the Mercedes convertible. You got that, but we're going next weekend, you're going on a family trip. I need the Suburban, and they'll bring the Suburban and switch it out. And then you want to switch it because you want the sports car or the fancy 4-door sedan because you got some friends coming in town. And you go, so you can switch the car out as frequently as you want. And they're all these A-type cars, Mercedes.
So it's a luxury car club.
It's a luxury car club. Yes. Think of like a boat rental club yeah.
That is really cool. I mean, it's a great concept really, because it allows you the luxury of being able to pick what you want.
And for as long or as little as you want. And the insurance is included in that. So now you don't need auto insurance because it's included in that lease payment. Anyway, it's a little more expensive, but not anymore. Not twice as expensive. Maybe it's like 20% more expensive than if you were going to lease the car yourself. But at the end of the time, so I literally have had several of my friends, but one of my friends, did this for about a year and a half, and then he's like, "All right, I've had enough." Right? It sounds like a great idea. It's kind of like you talked about. You bought the Ferrari. I drove it for the year. Now who cares?
It sits in the garage most of the time.
Yeah. So he's like, I saw all the cars, and the one I like driving around is the Toyota 4Runner, so I'm just gonna get a 4Runner. Like, I don't really need the Mercedes convertible or whatever. That's fun, but it's fun for like 2 weeks out of the year, or and then it gets too hot. Or anyway, it was really kind of funny. It was a way to test it out, right? He tested it out for about a year and a half, and said, it was fun doing it. Now I'm just gonna buy my car that I kind of like.
And that's exactly what it puts you in a position. Also, that's a really cool concept there. We got went from good debt to versus bad debt to, this is not a bad concept for people who have a lot of disposable income. Right. Where did the disposable income come from? Probably assets that produce income. Right. I mean,
right. Well, exactly. You get your business to pay for a percentage of that too, right? So you get your business to make a lease payment just like they would if you were leasing a truck or a car, right? So
I would think that would be fully tax deductible to be member of a club.
It's only up to a portion. The whole tax rule, there's limits on how much that is tax deductible. So it's not 100%, but there's a portion of it that is. But
yeah, and we didn't, just a disclaimer, we don't give legal advice.
We don't give financial advice on
tax advice on this show.
Check it out, right?
Although, if there's anybody who has experience in that area, it's probably you. So.
Well, I know a little to be dangerous, but this is not that show, but so we can talk offline. But this is actually pretty good. So we started this conversation, I think, with the good debt versus bad debt, and it was kind of, I liked your Cardone versus Dave Ramsey. I brought in there The Millionaire Next Door. These are all good sources you guys should check out. Rich Dad Poor Dad, Robert Kiyosaki, I think is his name. Good debt versus bad debt. And a good debt is income producing. You're borrowing money so you can make money above and beyond your payments, right? Bad debt is you're using the money, you're borrowing money to buy something that depreciates in value or just stagnates in value. And I guess,
and the questions to ask yourself.
Yeah. And
will this make me money or will it cost me?
Right. And part of what I get into is I trip across these after the fact. I want people to call me before they make these decisions, right? And I guess part of the purpose of this podcast is that, in the sense of, like, you don't know what you don't know. Oh, I didn't know we could have done that. Well, of course you didn't know that because you're not an expert like that, right? But we've dealt with people like that, and these are your options. At least you would know your options. You could pay cash, and that's great. That's Dave Ramsey, and that's comfortable. You could leverage to the hilt like Grant Cardone, and that's an option. You could do somewhere in the middle, and that's an option. And here's the way you can do it. Like, part of it, I think, is a lot of guys don't know what they don't know, and they make these money mistakes, good debt, bad debt, because they didn't know the other option.
And they also haven't been in the game long enough. This is what I see about these online entrepreneurs who figure out how to, like, run a Facebook ad, and then next thing you know, they're making just astronomical amounts of money. They don't think the gravy train's ever going to end, and anybody who's done Facebook advertising knows it will. Every advertising venue will change, I promise. It doesn't matter what it is. But they are not experienced. They haven't been around the game of business and life long enough to know that things change, and you got to think to the future that things will change, because they do in every business. Every business has a life.
Yeah, exactly right. And you mentioned that before. And I always talk about, you don't know what you don't know. And that's why you need other people's input and advice. And even if it doesn't change your mind, at least you're aware of the options, right? You want to be aware of the options. Not telling anybody they should own a house or rent a house. It's entirely a personal decision. But there are some decisions are better than others, and there are other options that you may not have known out there. So anyway, good debt.
If somebody came into $1 million, then what would your best recommendation be?
Literally, we tell people that don't do anything for a year, like literally, right? So if you're talking about a spouse dies and you get life insurance settlement, you talk about inheritance, you talk about you win a court case. Literally, the best advice is don't change your lifestyle for a year. Let's just see what's going on. Maybe you take a little trip, go on a cruise or go to the beach or whatever. That's totally reasonable, but we don't change our lifestyle the first year, because you don't really know what's that going to be like. And then we talk about, all right, Are we going to move, stay? Are we buying a house, keep the existing house? We're buying a second house. Would it be better? Because I also find this when people buy second homes, now they feel obligated that that's where they have to travel all the time. Wouldn't it be better to spend that money for the mortgage? So when you buy a second home, it costs you about anywhere from, well, let's just use $50,000 as a round number to buy and maintain and pay insurance and repairs and maintenance. Even if you're renting it out, you buy these beach houses. I see these numbers all the time. Well, it's like, gosh, well, for $50,000, you could go some nice vacations to some nice fancy places, as opposed to here, you're always going to want to go to that one house at the beach.
That's 5 really nice vacations.
Right.
Every year.
Right. So, and there are ways that we talk about, tax if you're a business owner, that a lot of your personal travel you can tie on the end of a business trip. So now your travel becomes tax deductible, or part of it tax. Not tax advice. I'm just saying that.
and if you're a copywriter and you have to be on a beach in the Caribbean to think and write properly for.
Well, you're doing research. They call that research.
Yeah. Sometimes you just have to be in a certain locality.
Especially if there's another copywriter there with you, because then you could have called it like a best practices kind of conference.
Gotcha.
You know what I'm saying? Again, not tax advice. I'm just saying I've heard it's done like that.
Yeah.
All right, man. Money mistakes, I should say. Good debt versus bad debt. Know what's out there. Know your choices.
And seek help. I mean, you name some books, and those are the reason we knew is because we both read the books. Those books.
Read them all. That's exactly right.
I mean, I like audiobooks. If I could get paid by Audible, I should, because I promote it all the time. I'm a 3-book a month at least on Audible every month, and then I read at least. I try to read. In addition to listening to 3 books, I try to read at least 1 book and take 1 online course and have a mentor. So seek advice.
Wait. I forgot. Well, that's good enough. I'll ask you offline. All right. Well, have a good one. This was great. Where can we find Dave Mulvaney?
You can find me at davidmulvaney.com. Connect with me on LinkedIn, David Mulvaney. And coming soon, and I say coming soon, if not this week, it'll be next week, ProfitabilityMD.com will be live.
Our new website.
Previous versions. Matt, where can we find you?
Yeah, so Matt Hudgins over on LinkedIn, and then I got 10x Profit, profitblueprint.com is the coaching website. And then, like we said, ProfitabilityMD.com is coming
and here. On that site, you'll be able to hear about our upcoming event in the early spring. So,
all right, man. Be good.
Matt. All right.